Matthew Queen, how are you? Happy New Year to you.
Happy New Year to you.
We're gonna have a conversation about captives. Matt gave a Twitter treatise, right? So I'll put a link to the thread that Matt created around there. But it's a really interesting take on captives. And for those of you that are unaware, I think this I'll just start out with like a basic definition. Captives are basically corporation owned insurance companies. They're insurance companies owned by a company that services the company, but it's so much more. And that's a lot of what we're going to get into. So Matthew Queen, why don't you give a quick introduction?
Sure. I am the Chief Risk Officer for Goldner Capital Management. GCM has entrusted me with starting a new captive, which I'm happy to report we have a license as of right before Christmas Eve. They awarded us with our license. So we are officially writing premium. We have two lines of risk, general and professional liability for skilled nursing facilities. What we do a little bit differently in the captive land is I think of it almost like a manual versus automatic. So we can control every single aspect of the insurance company down to the treasury. So we invest how we want to invest. We take the claims how we want to take the claims. We fight where we want to fight. We underwrite however we want to underwrite. And we, for all intents and purposes, act like a normal insurance company. We're fronted because in skilled nursing land, the federal government is involved. You got CMS with Medicare and Medicaid, not to mention a lot of these places are purchased with financing. So you got HUD financing, it's always an issue. Yep. And then various lenders as well. So everybody and their brother is going to want A-rated papers. We had to go get that. But we're basically, it's just, the paper's just a flow through. We're 100% reinsuring. It's just it's 100% quota share. So we're taking all the risk, and it's been months and months to put this thing together. So I'm extremely excited to be able to announce it on your podcast.
Yeah, thank you. You said months and months. That was going to be my next question, was how long it took. Can you give some insight as to why? Right. So let's talk. Maybe go into some of the details of what does it take to actually stand one of these things up.
Yeah, there's a couple of different types of captives. So you've got the historically bad captives, the tax dodge captives. I could stand one of those up in like 30 days. You just get a protected cell company, you funnel a bunch of money into it, you get some sleazy actuary to sit there and just say this qualifies for X number of dollars of premium, and you make the 831B election. The IRS hunted those things down with heat-seeking missiles, and they're dead. They're dead as a doornail. That era is done. The only captives that really matter anymore essentially function like miniature programs. And my thesis is that the captive model presents a better structure to get an insurtech up and running, or even an MGA up and running, than anything else I've seen in the marketplace, because regulatorily, there's a lighter treatment. And from a capital requirement, we have a little bit more discretion. So as an admitted carrier is going to be governed by the NAIC rules and a DOI for each and every state. A true single parent captive is only governed by one domicile, and that's wherever you are. So if it's in the Cayman Islands, Bermuda, North Carolina, Tennessee, you only have to deal with that jurisdiction. There are a few technicalities behind that, but for the most part, you're just dealing with one regulator. That is a huge advantage, makes things much easier to deal with, and gives you some strategic differences from the admitted carriers. So the way you invest your funds, the way that you tackle claims, and then the amount of money that you need to hold in terms of reserves or surplus is completely different. Again, they aren't going to bifurcate between surplus and reserves in many states. So that's a strategic advantage when we start talking about the float and correspondingly the amount of ALAY that you're spending on claims. You have a little bit different position than someone like CNA or AIG, who's in just a different place economically. So we're working right now with Defense Counsel, telling them all of this. Like, look, here's our expected returns. Here's how much the premium is. Here's kind of sort of what we expect to spend on you. Here's how we want litigation to proceed. this is a breath of fresh air for the defense attorneys because they're accustomed to the insurance company coming in saying less is more, and I want you to spend as little as possible, get the case cycle be as quick as possible. We don't want to litigate anything, and that can work, especially if you're getting 1 to 3% on your treasuries. But if your treasuries are significantly higher than that, then you can just play a little bit different game.
Yeah. So, part of my fascination with captives has always been control, right? So a company creates a captive internally to cover an exposure that they either can't cover in the traditional marketplace, or the traditional marketplace is so overpricing. So the premiums are so high in relation to what they've spent in the past or what they think is reasonable. You get some control over that, especially if you bring a lot to the table. So, but there's a regulatory thing that I was not aware of, that flexibility. So are you saying like there's no, for captive, there really is no bifurcation of like admitted versus not admitted? It gets sort of outside of that, that paradigm?
That's exactly what I'm saying. And if you're in the regulatory space like I have to live in, it's really hard to figure out what rules apply to you because most of your laws, DOI, they're going to, so like on treasuries, for example, I've just been working with that. I've had to learn all the rules about risk-based capital recently, and that's not necessarily the clearest thing. I honestly, in some states, don't know, like if I were incorporated in Arizona, for example, would the rules on surplus governance apply to us like the way they apply it to excess and surplus lines carriers, to admitted carriers? I don't know, because their statute is not clear in terms of the investments. And then you go to a state that has even worse laws, at least with regard to captives. Just going to pick one, Texas. They've got captive statute in place, but they don't really talk about investments. So how's the DOI going to look at it? And the honest to God answer is you got to talk to your regulator. And this is possibly the best and worst part of the job. So if I have a regulator who has faith, they'll let you do a lot. If you have a regulator who has skepticism, they're going to treat you like an admitted carrier. So one of the reasons that we used to be in the Turks and Caicos quite a bit was because the regulators, for the most part, just let us do whatever we wanted. All they wanted to see was solvency. That's all they cared about. I think that because of especially pursuant to the Trump tax cuts, they changed the rules a little bit. So offshore captives are just, it's more of an accounting issue, more not nightmare, but you definitely have more compliance than you used to. So I think strategically, if you're looking for flexibility or maximum flexibility with a degree of professionalism, I would recommend looking at Tennessee and North Carolina, followed closely by Delaware. They're smaller, they're great places to do business, and they're responsive. Hawaii and Vermont are also fantastic. I think Hawaii and Vermont lend themselves more toward risk retention land, so like risk retention groups. But the regulator that you choose to govern you is going to be your business partner in many ways. And that starts to get real important when you start talking about, okay, how much money does it take to get this MGA off the ground? Well, you know more about MGAs than I do, but I'm going to tell you that upfront. So let's say that you've got this new flood program and you approach, I don't know, who's a carrier who even touches flood? AIG, for example?
Sure. Lexington,
okay, right.
Lexington, part of AIG.
Okay, so Lexington says, all right, Lamps, you're like the best guy in the world at flood, but this MGA, it just, how do I know that your mousetrap is anything better than anyone else? So in order to kind of grease the skids a little bit, maybe you'll say, I'll take 5% each and every one. I'm going to reinsure this program. I'll take 10% each and every one. I'm going to reinsure this program pursuant to this captive that I have over in the great state of North Carolina. So you set up a single parent captive. It's technically a reinsurance company, and you're taking some of the risk off of your business partner. And now they see that you have skin in the game. But let's assume, for the sake of argument, I don't know flood insurance limits because I'm a casualty guy, but let's assume you got $1 million limits. How much do you need to put in the bank in order to be able to issue that paper? Well, in risk retention group land, or even admitted carrier land, you may be governed by like a 1 to 3 premium to surplus ratio. So you need to have basically like like $333,000 in the bank if you want to issue $1 million of premium. Okay. In captive land, you can get away with more like a 10-to-1 ratio or a 9-to-1 ratio. So I'll tell you right now, you're probably not going to get a 10-to-1 ratio out of the box, but maybe they'll let you open up a 5-to-1 or 7-to-1, and you can grow into 9-to-1. Now, how do you get that degree of confidence? Well, a couple of big things. Number one, who's your captive manager, and do they know the regulator? If they have a good reputation and they're betting on you, that'll help you get to that more flexible area. So all that does is just truncate the amount of money it takes to get your captive up and running. And then let's assume, for the sake of argument, your premium grows over the course of the year. So we were looking at $1 million, but now it's more like $5 million. Am I suddenly insolvent? Well, not necessarily. If your premium is growing fast enough, the regulator may just sit there and work with you and say, all right, let's see how those losses come in. If the losses look good, maybe we'll just sit there and let that premium get contributed towards surplus, and we'll let you basically self-collateralize over the course of a policy year. And I've done that many, many times. So then what you've done, going back to the program land, you're sitting there saying like, look, Lexington, I'm putting my money where my mouth is. But then you got to go back to your stakeholders and say, look, I don't need $500,000 to get this captive up and running. I need more like the statutory minimum, which is going to be like 125 to 250 grand in the bank, just as the minimum amount. And then you can grow that over time. So where I like this a lot is you can actually reduce the total amount of collateral that you need for a program by leveraging a captive. So if you have a 1-to-3 ratio on, let's just say a risk retention group, but over here in this captive, you have a 10-to-1 ratio, you could reinsure the risk retention group and basically pull the money out from one area and take it to another domicile. Tried and true strategy. People do this all the time. In fact, I can tell you for sure that moving capital around into reinsurance facilities is just a smart way to make your money go a little bit further. Obviously, the corollary being you do have to have performance and losses. So if you start to get eaten up, you could end up sideways with the regulator, and then you're going to get kicked out of the domicile. So just as you can burn a reinsurer, you can burn a regulator, and they talk. So make sure that you know exactly what you're doing. But this strategy kind of pulls captives away from just these one-offs where you just have this huge company like Google has a cyber insurance problem, so they're going to create their captive. That's the traditional captive. I'm saying that captives as a structure can be leveraged as a part of an MGA strategy. They can be used to get insurtechs off the ground, and it can be generally leveraged to start a kind of like a training wheels program for something much, much larger that you want to do down the line. So if you want to become an admitted carrier, leverage the captive statutes to get up and running, maybe use a front, get yourself your underwriting algorithm trained up, see how much surplus you can generate on your own. And then when you're ready, just go buy an admitted carrier, go buy the licenses and raise that capital after you have a proven business model.
I should unmute. It's going to happen every single time. It gets to things that I've been discussing around the lack of agile opportunities in insurance, the ability to create and create something very inexpensively to validate something to then get it to the next step. In insurance, because of the capital requirements, essentially, when you're an insurtech startup and you're not like you're looking to have like some sort of underwriting edge, in the past, there's only been like two choices to make. You're either going to be an MGA or you're going to be a carrier. Well, carrier is like tens of millions of dollars of capital that you're going to need to get that thing up and running. So everyone defaults to the MGA, but the MGA is also very expensive. So I think part of what you just said that is intriguing about the captive land is that I would almost, given what you just said, I would almost advise anyone that's starting an MGA to almost say, hey, listen, if you do indeed have a better mousetrap around this, you should just make a captive part of this structure, because ultimately what you're saying is that if you're successful, you're going to be able to validate your success, and then it's a smaller bridge for you to then become a carrier at some point in the future.
Yeah, I think you can even get more aggressive. And I'm not, now this next thing I'm going to say I've never done, but it can be done. You can underwrite third-party risk in a captive. I generally prefer to go through the risk retention group model because it's actually designed to bring on third parties. You can sit there and act like a carrier under the risk retention group model.
Can I pause you for a second? Because I think I know, but therefore I feel a responsibility to the audience that's listening. Describe the difference between the risk retention group and a captive and some of the nuance around that.
Yeah, so you got, in my mind, just a handful of different types of captives. And these are all creatures of legislation. So each domicile is going to treat them a little bit differently. But over the course of the past 50, 60 years, everyone kind of sort of agrees on the following definitions. A single parent captive would be a subsidiary of a corporation. So Procter & Gamble wants to insure its liability risk for product liability because they're getting a bad deal in the market, or they want to reinsure their carrier, self-insured retention, something like that. They would have a captive. And then that captive would then provide liability to a significant number of the subsidiary companies of Procter & Gamble. And that is basically the Humana case from the late 1980s that blew the doors wide open and said captive insurance is in fact a thing. This is how you would do it. So the single parent captive model was more or less ratified by the tax court in 1989. In addition to that, you've got group captives where multiple companies will come together and do the exact same thing. They'll create an independent, not a subsidiary, then it's just almost like a JV where this one corporation is going to provide some sort of coverage for the group. This is really common with PEOs where they just get beaten up on workers' comp. So they'll all share, they'll all have like their own they'll all have their own, let's just call it a self-insured retention for the first $1 million policy. Like the first $100,000 will be like a deductible. That's really a self-insured retention. Then they'll have a shared layer above that. We'll call that the B layer. So the A layer would be an SIR. The B layer is also an SIR, but now it's actually in the captive. And that'd be the 400 excess of 100. Everyone would have an obligation to basically pay claims. You generally do that on an incurred retrospective rating plan. Then the 500 excess of, or the 500 excess of 500 would be with a carrier. PEOs do this because $500,000 deductible is kind of sort of expensive. And if you can spread that cost across enough people, you can then at least get a pool large enough to get a real carrier to provide the coverage. Because PEOs are extraordinarily difficult to underwrite for. Travelers and Liberty Mutual just won't touch you unless you've got an aggregate of 10, 15, 20 million bucks of gross written premium. So that's where the group captive does very, very well. Now, pivoting off of that model, because it's really clunky with the securities. With a group captive, you have to have A shareholders and B shareholders, and everyone has their own rights. And it's a pain in the butt with that mergers and acquisitions to bring people in and out. So they're let's just say it's illiquid. The protected cell model solves that problem. So you've got a fist, that's your core company, then your pinky finger is cell number 1, ring finger is cell number 2, so on and so forth, until you have an infinite number of cells that all essentially operate pursuant to the core company's license. So each cell is basically a prefabricated license. And then the regulator is only going to audit from the core company down. So when you talk about solvency, do you need to actually show up with any money? The answer is it depends on how much money is in the core company. If in aggregate, the cells are solvent, the regulator pretty much blesses you and says, have a nice day. The protected cell model was a great way. If you had, let's just say $5 million and you said, hey, I'm going to offer this thing in the captive land. I just want to go get a whole bunch of premium in the door, but I don't want to deal with every one of these captives having to go through the licensing process and the time involved. You can just open up cells. You can literally get them up and running in 30 days. So the cell model created fast captives, really useful for small captives. The downside is that your management fees are much, much higher because now the core company is essentially auditing all the cells. So the manager is going to have to do a whole bunch more work. So they're just expensive. So that's like just like the traditional captives. You got my bread and butter, the risk retention group. That is almost like an admitted carrier that came around in 1977 or 9 when there was a product liability crisis. And the Congress just said, look, there's no product liability available for anyone. We need to pass a law that has an exception to the McCarran-Ferguson Act. So McCarran-Ferguson said that the business of insurance is state law. So then Congress said, we're going to abrogate that for one situation, product liability. You can create admitted carriers that will be able to write across state lines. Huge deal. You probably heard in Obamacare debates, they were talking about allowing health insurers to compete across state lines. Trump said the same thing. We should allow health insurers to compete across state lines. So this is a frequently brought up concept of how to try to improve the insurance market. So the Risk Retention Act was awesome. It worked really, really well. The product liability crisis quickly abated, and then they expanded it from the Product Liability and Risk Retention Act to the Liability and Risk Retention Act. So if you have an RRG, you can write liability across state lines. So now if I start Matthew Queen's very special RRG, I can go up against AIG, and instead of doing a filing in each and every state where I want to compete, I do one filing to rule them all. So if I incorporate my RRG in Hawaii or Washington, D.C., where they do have regulators who get these things, then I just march my way into Texas and California, and I just tell everyone, here's what I'm charging. Here's my rate. Now, the secret sauce there is that your average admitted carrier is going to have an expense load of anywhere from 33% to 40%, depending on how efficient they are. So it's expensive. So their loss ratio realistically cannot go above 60%. The RRG is going to be more like 15 to 20% expense load. So structurally speaking, you have a significant advantage. So you can come in and you can be the cheapest girl on the block without having to give away any underwriting discipline. The problem with an RRG is that it can only write liability. So when you start structuring your captive ideas, you got to understand like how to leverage these things. So the RRG, huge advantage, but limited. Okay, but what about the captive?
When you say liability, is it still just product liability?
No. So in 1981, they expanded from product liability to literally any liability. So nowadays,
any casualty line.
There's exactly.
Yeah.
So actually liability goes pretty broadly. So you've got the obvious liability, product liability, professional liability, D&O, any sort of med mal. There's a bunch of risk retention groups to do that. Then you've got liability to an employer. So let's say, for the sake of argument, you've got a health insurance plan for 10,000 employees, and you're just getting beaten up. 900 grand a month going to Blue Cross or whoever. You do a self-insured retention for, let's say, the first 100 grand per claim. Then you purchase stop loss above that. That's typically speaking how you reduce your costs in a health insurance plan. Well, your captive. That stop loss layer is technically a liability to the employer because they are obligated to indemnify the healthcare plans or reimbursed healthcare plans. So you can actually put that stop loss, you can reinsure the stop loss carrier via a captive. And if you want to go one step further and kind of take over the market, you could create a risk retention group, which provides liability coverage for the stop loss layer above some sort of a retention. And that hasn't been done before, by the way. And what people do is they leverage that as part of a broader strategy to try to take control of out of control healthcare costs.
Yeah, that's wild. The entire flexibility of these things are wild. And so before we went off on a tangent and I interrupted you, I apologize. You were going into how you can convert these. So that's another element of this flexibility is that going out into the future, these things can evolve into prototypical structures as well, like a regular admitted carrier at some point. It sounds very familiar to how like affiliated FM or factory mutuals started. It sounded, a bunch of homogenous groups got together and then it became like a thing where they could absorb additional exposures.
Yeah, so you're hunting down a path that's actually been done once or twice. So I look at the greatest captive of all time as Allstate. People don't realize that Sears and Roebuck actually started Allstate, and it was a captive. And it got too big for its britches, and they spun it off, and it's done pretty well since then.
Pretty
So
well.
there
Wow.
is a model to take the captives from the corner. I mean, listen, I know where we are. We're not exactly front and center. People barely know what they are. But you can take a captive and church them up into the admitted carrier land. You're going to be heavily governed. It's going to be much more expensive to be an admitted carrier, but there are some advantages to being an admitted carrier, and there's some real disadvantages to being a captive. So if you have an RRG, brokers don't like you. And for better or worse, we depend upon brokers to get policies out, especially when you get in commercial land. I mean, auto and homeowners and personal lines, you can do direct, and maybe small business stuff you can do direct. But as soon as you start talking about, I need a commercial policy for offshore oil rig, you ain't doing the internet submission for that. Like, you need to have a broker who really understands, like, here's how we're going to layer this thing up. And likewise, any degree of complexity, you're going to have to deal with the politics. Do you have A-rated paper? Is it with AM Best or is it with Demotech or Fitch? And then are you going to be able to convince people that you'll be there for them? I mean, my God, I mean, when you start talking about the captive land, the big flexibility is less money to get up and running. So what happens if you get burned? Can you go out of business? And the answer is obviously yes. So you're not going to have the degree of confidence from the market that you necessarily would if you showed up saying, hey, I'm Travelers, or hey, I'm Nationwide. It's just, it is what it is.
Yeah. And so would you say, like, an interesting way for companies to think about this, right, is it creates financial flexibility for your organization around risk transfer. But I think of it as like the difference between self-insuring and the captive, because when I've tried to describe it, it's like, oh, you're like self-insuring. I said, yes, but there are some of the tax advantages, and you and I have talked many times about, like, that's not the primary reason you use it. But then it transitions to, well, if you own your own insurance company and you do have an underwriting edge and you can invest the float, it's an asset, right? Like, you're almost like Warren Buffett. Talk about the flexibility in in what you can do with investing the float and what the float consists of.
Yeah, so this is 100% going to be domicile by domicile. So I can tell you that DC, North Carolina, Tennessee, and Hawaii are relatively similar in that you can invest your assets virtually without impunity. They only are concerned about two broad factors. Number one, liquidity, and number two, solvency. So solvency is going to be a calculation on a state-by-state basis, and I won't get into that because it's complicated and there's a little bit of, let's just say, wiggle room, shall we say? I mean, really, I mean, the regular, I mean, we are, so like I said earlier, we're getting away from automatic going into manual. When you really start talking about this kind of stuff, you're driving a manual transmission here, and you got to bring the regulator along with what you're doing. Because if you can demonstrate, not only through your actuary, but also through real world experience, that you're a better risk than others, they'll work with you. So you cannot, okay, here's what you cannot do ever. No loans from a captive unless the regulator's damn sure that it makes sense. And then no options trading. Outside of that, you're pretty much good. Now, I know that's wild, because now you're starting to think, well, could you do
cryptocurrency?
Could you invest in Bitcoin? Yeah, absolutely, 100%. Like, that could be a significant chunk of your portfolio. Now, the volatility of that may create some questions. So if you had 50% in Bitcoin, would that fly? No, because the volatility of that may impair at sometimes the solvency in the middle of the year. And then, are you really liquid? So if that thing goes down by 50% because Elon Musk says something stupid, then you don't really have the liquidity you think you do. So there are some natural guardrails on it. But so this is captive land. You get to do a lot. Over in RRG land, where you're governed by much stricter rules, the NAIC will sit there and impose a risk-based capital ratio on you. They're gonna rate every one of your investments. It's gonna look like an admitted carrier. And RRGs are easier to get brokers to sell because they're strictly regulated. They don't go bust too often, and it kind of looks and feels like an admitted carrier. A captive, on the other hand, is damn near a reinsurance carrier. And we all know the reinsurance carriers can do basically whatever the hell they want. So captives get a similar legislative grace.
Yeah, I'm mentally processing the transition of captive to carrier, but in a way, like the organization that created the captive can still remain in the game by having like, they can evolve it from captive to carrier, but still maintain like a reinsurance captive that's helping the new carrier get off the ground. Like there's so many feedback cycles. It reminds me of part of the problems that Lloyd's got into in the 1980s, where you had syndicates who were, you had Lloyd's reinsurers who were reinsuring syndicates, and then they themselves were retroceding back to the same syndicates that they were insuring. And it was just the exposure was just passing back and forth. No one was actually transferring it to someone else. And then it kind of blew up. Could the same problem occur in this kind of situation?
Absolutely. The undercap. So if the regulator's job is to sit there and figure out, okay, do you have enough capital to bear the risks in this domicile? And then let's look at that reinsurance treaty. And if the reinsurance treaty is with another captive, they should probably take a gander at that and figure out, okay, what's really going on here with the reinsurance? I'm telling you that for the most part, they won't, but they probably should if the captive is then in turn reinsuring, let's say 100% of it. I know for a fact Hawaii does look at that. If you look into their domicile, they actually say in their application, hey, we want to look at what your reinsurance treaties are. So you can't play games, but there is a strategy. And I know it's kind of the same thing. What I'm saying is you can't play cynical games with money, but you can absolutely be more efficient than if you just tried to say, gosh darn it, I'm going to be the next, nationwide.
What has just changed in the past couple of years? Because aside from the market getting hard, and I think the pandemic opening a lot of eyes, it seems like even from a regulatory standpoint, talking to you, talking to Jeff Clyde, like the ability to add flexibility has increased. It was already flexible. Have the fees gone down for something? Like it's just easier to get these things up and running? It just seems like everything's smoother and a lot easier. It's, in my mind, it's almost like you'd almost be silly or foolish not to have this in deep consideration as you're starting an MGA or starting some sort of risk-bearing entity.
Well, I think you had a confluence of factors. Number one, you had the de facto death of the tax shelter captive industry, and that evaporation has started to improve the general perception of what we do, which is good. It's good. Yeah. So we can now have these kinds of discussions without having to say, "Oh, pretty please don't bump me in with all those guys." So that's good. Number two, there is a renaissance in the insurance industry right now. This insurtech movement is no joke, and it's reasonable to think it may actually become the darling of the dance pretty soon within the general fintech movement. So insurance has woken up, or investors have woken up and said that insurance it's a fax machine industry, and there's areas for improvement. And if you spent any time in a carrier, you know for sure there are some areas, deep areas for improvement. And insurtech provides the quickest way of being able to deliver on that promise. And there are some new players in the market. And you mentioned Jeff Clyde, one of his colleagues, Jeremy Kolomik over with MSI. They are moving in this direction, this really sophisticated direction. This is where they want to make their bones. And they have a few competitors in the marketplace who are also moving in that direction as well. And there aren't that many of them. There really are not. The majority of the captive industry was not really insurance focused. They were tax focused, and they're basically gone. So as a consequence, now you're seeing that those who are left remaining, working with this new insurtech crowd, and let's face it, capital's cheaper than ever. So it's much easier to get things up and running than it was 5 years ago when capital was much more expensive. 10 years ago, it was even more expensive than that. So I don't want to sound like there's no good reason for it, but sometimes in life, it's just things have their heyday.
Yeah, it's so interesting. So let's end it this way, Matthew. There's an insurtech company that's starting. They have built some technology that gives them an underwriting edge in some market, they've spoken to a lot of insurance professionals about, should we form an MGA? Should we form a carrier? They decide to form an MGA. What would be your sales pitch on why a captive should be a part of this? How would you advise them?
Yeah, no MGA is going to get anywhere without a carrier. So when you show up and you say, look, I'm willing to take X% of the risk, you've just made that sale with the reinsurer or the carrier so much easier, because now you've shown that you've got a vested interest in it. And oh, by the way, your total profits will be increased because you have that captive there as well. So you're taking a little bit of the risk off their books, and you're keeping some of that conceivable underwriting profit for yourself. So you've not only just supercharged your MGA, so we should be getting from A to B much, much faster economically, but now you've given a little bit more confidence to the carrier. And this is soft, this is not objective, there's no like rule behind this, but you know carriers, they're skeptical by nature. And if you can come in there with a little bit different product, which they like, followed by the real skin in the game, they're going to immediately separate you from the other 10 people who want to start their MGA this year, put you in that crowd and say, okay, let's look a little bit more closely at this underwriting model. Let's look a little bit more closely at that captive. So if they're actually going to reinsure this thing, are they actually reinsuring it? Or are they then laying it back off to somebody else? Like, how sophisticated are they? And then from there, you can sit there and play some real games with the carrier. So they're not going to sit there and play games, play nice with whatever deal you want with them. Fine, we'll take our captive and we'll expand that. We'll go get reinsurance, and we don't need you anymore. We'll go get a reinsurer. We'll sit there and provide the capital. Now we're going to have our own deal. That gives you leverage. Now the reinsurer, of course, you have to have paper and you have to have other compliance. I mean, every line of business can be different. But just even having that in your back pocket of being able to say, I've got surplus over here that we built over the past 3 years of $5-10 million. I go off to Swiss Re. All of a sudden, do I even need you anymore? Now the MGA's got a significantly different power balance than if you just are saying, pretty please don't cancel my program.
Yeah. And that's the challenge for anyone that's listening around the MGA model. Is traditionally or historically, MGAs were brokers who developed some sort of niche, right? So they became actually better underwriters than the underwriters at the carriers, because they had built such big books on a specific niche. They knew the ins and outs of that. So the carrier would essentially just turn over the underwriting to them and lay off the expense of trying to support that business and just let the real experts do that. But those brokers had leverage in the market because they had already built the book of business. These insurtechs that start MGAs now have no leverage. And that's why I always advise startup MGAs that you're going to need at least $2 million in 2 years. Like, that's what you should budget, because you have no leverage in this. You're bringing something to the table and asking a carrier as a leap of faith to believe you. They might ultimately do that, but there's going to be a long vetting process to work through that. So 2 years and $2 million with a captive approach, you can get up and running faster, right?
I think the captive reduces that VIG, and then obviously, we'll have to run through the numbers to figure out how much we get that down. But yeah, you can reduce that by 40-50%. You touched on something before we part. I do want to raise those brokers who are better underwriting than the underwriters. Every one of them need to reinsure their book of business. Start an agency captive, take some of that line, and then go make a better deal with the carrier. You want to make 30% commission? You can do that with a captive. And I said that to a broker one time. They said, "You got to be kidding." I said, no.
Yeah.
You're not going to get 30% right off the top. So the way it works is you get your 10 or 15%, whatever deal you have, and then you take a layer of the risk within your captive, and then you're going to be getting a little bit of money for underwriting the premium. And then also any profits in that line, you're going to get 100% within that layer of risk. So you end up with a situation where if you're big enough, you can even maybe get a ceding premium from the carrier itself. And at that point, you've really changed the game. The power dynamic goes from the carrier down to the brokerage. Again, someone like, Marsh and Aon, they've already done this. So where I think the protected cells are interesting is because they've lowered the cost to get in the game so low that the brokerages that are any good, if you got, let's just do commercial trucking, for example, if you got $1 million or $2 million of top line revenue, you got to at least look at a protected cell and take a couple $100,000 in that captive, because it doesn't cost that much money to get in there. And if you bet on yourself, all of a sudden you're going to accumulate some surplus. And if you start having a little bit of problems with your carrier because they want to exit the market or whatever, you can literally bring a carrier into the market by sitting there saying, look, I'm losing AIG, but I'm going to bring in CNA over here. But here's why you want to bet on us. Get the filings in place, work with us, and you're not even going to take all the risk. All of a sudden, you're in the game as opposed to just, again, praying that the carriers understand how to manage the losses.
Yeah, it's not an expense; it's an investment. You're betting on yourself, like you just said.
Yeah, and it worked out really phenomenally for the big shops because they were in the old regime where it cost a lot of money to get in, so not many people could do that. I think where the protected cell model has changed the game a little bit is the regional and even smaller brokerages. If you got one line of business that's just killing it, absolutely looking at the loss ratios. I got a buddy of mine starting RRG precisely because his friend was a broker who reverse engineered the losses or reverse engineered the profitability. And it occurred to him, he was like, look, we have like a 10% loss ratio. We're the best gosh darn commercial trucking brokerage in at least the state, possibly the region. What the hell am I doing here? So we started an RRG to reinsure the liability, and basically just I think they're taking the first 100 or 250 each and every one. They're printing money. Money.
Yeah, but you have to have the edge, right? Like I think everything really the foundation that you're setting this on is that you have some sort of edge, and it allows you to expand margin in ways that you otherwise couldn't. It allows you to get leverage in the marketplace in a way you otherwise couldn't. I have two remaining questions. One is protected cell. Can protected cell model also spin off to a carrier potentially?
Yeah, absolutely it can. I bifurcate between single parent captives and protected cells needlessly. They basically are the same thing. It's just a legal difference between the two. The protected cell can do anything a single parent can do. It's just faster to get up and running, but more expensive on the back end.
Yeah. Okay. And second, what lines just do not lend themselves to captives? I'm assuming personal auto, probably personal lines. Where would you kind of draw the line, say these just aren't going to work?
Yeah. Technically personal lines could be done if you had just $1 jillion running through a brokerage. I'd look at it, but you'd have to have like $1 zillion. Like it would have to be unreasonable. So you're right. Personal lines are pretty much out. Healthcare is basically out. Commercial healthcare for employees, we can talk about, but like actually providing healthcare coverage, no, that's a different world. Believe it or not, you can do life. You can actually have captives and life insurance. That is a well-worn area for tax dodges. So you can really know what you're doing there. You can do fully paid up life insurance through captive insurance. I've done one or two of those. And then the field of property is tough. I know there are some property captives out there, so I won't say it can't be done. But again, are you Exxon? Because they do some property reinsurance for, like, again, their oil rigs or the midstream pipelines. They're not, you're not doing property insurance on a captive for, like, somebody's really nice house. Like it's the bucks in property are just so huge that, I mean, you really do have to capitalize those things with like $250 million. So that's not really good. So I would say anything casualty where you've got some real limits in place, you ought to at least look at it.
Even casualty on the personal lines, like D&O for someone who's in a homeowners association, or their liability if you're a rock star and you like to break guitars in hotels.
Yeah, as a matter of fact, you can do captives for that. So now that would be like a micro captive, but for like the rock star, I basically set him up with a bank account. We call it a captive, but he'd more or less just be funding a savings account, get this huge tax advantage, and then we could sit there and pay out dividends every year. Now, in order to make that regulatorily compliant, it'd have to have some serious risk distribution. You can get that because, one guy, there's obviously no distribution of risk. So the way you get around that is you get a reinsurance agreement. Hopefully your manager has some other clients, and you just reinsure some of the other captives that they already have. And you take a layer of the risk that you're comfortable with, and the IRS has to bless it.
Okay. So I'm going to write about this in an extensive blog. You are a published author in this space. So why don't you give a plug to your book?
Sure. Yeah, we wrote the best treatise on captives so far. It's called Modern Captive Insurance. You can find it through the American Bar Association. I wrote it with my great buddy, Light Townsend. He is the chief legal officer over at a hemp company, Greenpoint Re, and they've actually started their own captive. He has a protected cell that, or actually he has a core company, and he started a protected cell providing warranty coverage for hot hemp. So in federal law, your THC levels for hemp may not exceed 0.3%, but part of the problem is after you pluck the plant, sometimes it continues to produce THC no matter what you do. So as a consequence, somebody will buy some material or some biomass from them, and it becomes illegal. So then they indemnify people via their captives.
There's a risk there.
Move.
Yeah, there's a risk there. So so he's eating his own cooking. If folks wanted to learn more about captives, how would you recommend they do that?
Just talk to me. You can find me on Twitter, Matthew Queen 84 at Matthew Queen 84, and I'll talk to you. I mean, there's so many materials out there that talk like it's the most complicated thing in the world, but I mean, it's basically just, I'm going to open up a new bank account. We're going to put a license on it. And there you go. That's your captive.
I can't stress this enough. Like I think the modern day underwriter can't be called that if they don't understand captive insurance, because I think at the end of the day, captive insurance is going to it's going to get in the limelight here and become part and parcel of the toolbox that we all need as, risk officers or underwriters or whatever, program administrators. We're going to have to speak the captive language. So Matthew Queen, I appreciate it as always. Happy New Year to you.
Oh, Happy New Year to you. Thank you very much.